There's a night somewhere in your investing life when you check your account and discover the balance jumped more in a single month than you managed to save in an entire year, and you didn't lift a finger to make it happen. No promotion, no lucky stock pick, no overtime shift. The market simply handed you more than your best saving year ever could, quietly, while you were sound asleep. Most people sleep right through that moment. They keep grinding, keep denying themselves, keep treating every single dollar like it's mission critical long after the real engine behind their wealth stopped being their paycheck and started being the money itself. Because there's a specific balance where the engine switches over, where your paycheck quietly hands the job off to the market and never takes it back. Cross that line and saving harder barely budges your final number anymore. And the cruel irony is that the people who reach it are almost always the last to realize it happened. My name is Root, and today we're going to pin down that exact number, explain why almost nobody gets the chance to reach it, and reveal what it does to the rare few who do. This concept lands better with real people attached to it, so let me introduce two of them. We'll call them Elena and Marcus. Same age, 38, same city, same sensible portfolio strategy. Both started investing in their late 20s. For roughly a decade, their account balances crept upward in that slow, unglamorous way that makes you quietly question whether any of it is even worth the effort. Then something pulled them apart. It wasn't their income. It wasn't luck. It wasn't a hot stock tip. It came down to one piece of understanding that Marcus grasped and Elena never did. By the time we finish this video, you'll know exactly what that piece of understanding is. I'll also walk you through the one scenario later where reaching this number and trusting it too early quietly destroys you, because it very nearly wrecked an entire generation of investors and almost nobody saw it coming. So stick with me for that part, because this video isn't really about saving harder. It's about the precise moment the game shifts from you to the market, and whether you even notice when it happens. So let's track down the number. And the math behind it is almost embarrassingly simple. The whole concept is what people call the crossover point. It's the moment your investments start earning more in a year than you personally contribute in a year. Below that line, your savings are doing the heavy lifting. Above it, the market takes over the job and it never hands it back. Here's how you calculate yours. Take the amount you put in every year and divide it by the return you expect to earn. That's the whole formula. Let me make it concrete. Say you're a disciplined saver putting away $12,000 a year, and let's use 7% as a reasonable long-term return, since that's roughly what a stock-heavy portfolio has averaged over the long haul once you strip out the fantasy numbers. Divide $12,000 by 7% and you land at about $171,000. That's your crossover. Once your portfolio crosses $171,000, an ordinary market year throws off more than your entire $12,000 of yearly sacrifice, all on its own, without so much as a thank you. Now watch what happens when you crank up the savings. Say you're really pushing it, maxing out a 401k at around $23,500 a year. Divide that by 7% and your crossover jumps to about $336,000. Stack a 401k plus an IRA plus an employer match, call it $30,000 a year total, and your crossover lands around $429,000. So depending on how aggressively you save, the point where the market out-earns you falls somewhere between $300,000 and $500,000. If I had to give you a single number to burn into memory, it's $400,000. That's the neighborhood where, for a committed saver, one ordinary year of market return starts quietly beating one full year of your best possible effort. And here's the part that should really grab your attention: it doesn't level off there. It accelerates. Because once the market is doing the heavy lifting, the pile it's working with keeps growing, so its share of the growth just runs away from you. At $400,000, a 7% year produces about $28,000 of growth. At $600,000, it's $42,000. At $1 million, 7% works out to $70,000 a year, showing up without you doing anything at all. That's more than double the absolute maximum you could legally stuff into your retirement accounts in a year. Your maxed out, ramen noodle, no vacation savings effort becomes a rounding error next to what the portfolio produces on autopilot. And I haven't even touched on volatility yet, which is where things get almost comical. On a $1 million portfolio, a 15% up year, good but nowhere near extreme, adds $150,000. $150,000. Meanwhile, you, sweating and disciplined and heroic, contributed maybe $24,000 for the year. The market's mood swing in a single year outpaced your entire annual contribution sixfold. At that stage, saving more isn't the lever anymore. It's a garnish. You're seasoning a meal the market already finished cooking. Here's another way to feel the effect, and you can do this one on a napkin. It's called the rule of 72. Take 72, divided by your return, and you get roughly how many years it takes your money to double. At 7%, that's about 10 years. So follow Marcus. At 35, he's sitting on that $400,000 and basically stops adding to it. He just lets it ride. By 45, having contributed essentially nothing more, it's around $787,000. By 55, it's roughly $1.5 million. By 65, it's about $3 million. And Marcus hasn't meaningfully saved a dime since his 30s. His money doubled, and then doubled again, while he was off living his life. There is no saving schedule on Earth, on a normal human income, that can compete with that kind of growth. Now, I know what some of you are thinking, and it's a fair point. This is great for some hypothetical person, but what's my number right now, at my current age? So let's make this personal, because there's a cleaner version of this idea that answers exactly that question. The early retirement community calls it CoastFIRE, and it's beautifully simple. CoastFIRE is the amount you need invested today so that, without adding another single dollar, it grows into a full retirement nest egg by the time you turn 65. Hit that number and you never have to save for retirement again. You just cover your living expenses, and everything already sitting in the account finishes the job on its own. The math here is really just the crossover point wearing a nicer outfit. You take your retirement target and run the compounding backward to figure out what you'd need today. Say your target is $1.5 million by age 65, at that same 7% return. If you're 25, you'd need roughly $100,000 invested today to coast the rest of the way. Just $100,000, and you could theoretically never save another dollar and still land at $1.5 million. If you're 35, it's around $197,000. If you're 45, with only 20 years of runway left, it jumps to about $388,000, because there's less time left for compounding to do the work, so more of the weight has to already be sitting in the account. And notice that Elena and Marcus were both sitting on $400,000 at 35. They weren't just at their CoastFIRE number, they were double it. They'd already locked in a comfortable retirement twice over, and only one of them ever realized it. You can see the pattern here, right? The younger you hit your number, the smaller that number needs to be, because you're giving time the biggest possible head start. A dollar invested at 25 gets decades of work out of it. A dollar invested at 55 is basically an intern who shows up on the last day and asks where the coffee machine is. This is why everyone shouts at you to start early, but they usually forget to explain the actual reason why. Starting early is what lets you reach the crossover point while you're still young enough to actually enjoy having reached it. And this ties directly into the thing that fools nearly everyone in their first few years of investing, which is that compounding feels like a total scam right up until the moment it doesn't. Growth isn't a straight line. It's a curve that stays flat and boring for a painfully long stretch and then suddenly shoots upward near the end. Over a 40-year investing life at 7%, something like 80% of your final balance is growth, and only around 20% is money you actually put in yourself. Sit with that for a second. 4/5 of what you end up with is stuff the market generated, not stuff you personally saved. And most of that growth shows up in the final decade, once the snowball is finally big enough to matter. The first 10 years, you're pushing a stalled car. The last 10, you're watching it roll downhill on its own while you jog alongside pretending you're still the one pushing. Which brings us back to Elena and Marcus, because now the split actually makes sense. Around age 35, both of them cross that $400,000 line. Marcus notices. He does the napkin math, realizes the market is now out-earning his own contributions, and understands that the hard part, the part where his savings built the foundation, is essentially finished. So he eases off. He still invests a little, but he stops treating every dollar he spends like a moral failure. He takes the trip. He cuts back his hours a bit. He lets the machine run on its own. Elena doesn't notice. She still skips the wedding because the flights cost $300. She still runs the grocery total in her head before she reaches the register. At 55, with more money than she'll ever spend in her lifetime, she still opens her banking app first thing every morning like it might have betrayed her overnight. And here's the gut punch we'll circle back to: by 65, Marcus, who mostly stopped contributing, has about $3 million. Elena, who never stopped, has about $5.3 million. Over those 30 years, Elena personally poured in over $700,000 of her own money. The market handed Marcus $2.5 million while he was essentially asleep at the wheel. Her entire 3-decade grind added less than what the market handed to a guy who quit trying. But before we get to how that story wraps up, I need to be honest about the massive asterisk hanging over this entire video. Everything I've described so far, this magical crossover point, this moment where you finally get to exhale, assumes you can actually reach $400,000 in the first place. And I need you to hear the real numbers, because most of the internet won't tell you this part. The median retirement savings for an American household sits at about $87,000. Median, meaning the household sitting exactly in the middle, and that figure isn't remotely close to the crossover point, even for a modest saver. Now, you'll hear a very different figure thrown around, the average, which sits at about $334,000. And that gap right there is the single most important thing in this entire video. The average is nearly 4 times the median. Why? Because averages get dragged upward by a handful of enormous accounts sitting at the top. It's like Jeff Bezos walking into your neighborhood bar, and suddenly, on average, everyone in the room is a billionaire, yet somehow nobody can pay off their tab. A few massive balances pull the mean way up while the typical person sits way down at $87,000. When someone tells you the average American has roughly $250,000 saved, they're technically correct and completely misleading at the same time. The average American looks like they're closing in on the crossover. The typical American, the one sitting in the middle, isn't anywhere near the same solar system. Only about 5% of households have $1 million or more sitting in retirement accounts. And I want to be clear about why. Because this is where a lot of finance channels turn cruel and stupid. They'll tell you the median is low because people are lazy, or they bought too many fancy coffees, or they lack discipline. That's garbage. The reason most people never reach the crossover point isn't a willpower problem. It's an income problem. Wages haven't kept pace. Only a small slice of people can even afford to max out an account, and the cost of simply existing eats up the margin that used to turn into savings. You can't divide your contributions by 7% to find your crossover if there's nothing left over to contribute in the first place. So if you're watching this and your number feels 1,000 miles away, hear me clearly, you are not failing. You're playing a game that got quietly rigged while everyone else was busy blaming you for the final score. Oh, and before I forget, since it fits right here, if you're the kind of person who wants to actually change the income side of that equation, not just keep slicing your existing paycheck into smaller and smaller pieces, I built a free community where I break down exactly how I think about building extra income streams and applying all of this in the real economy. The link is below, and honestly, it's the lever that actually moves the needle once your savings rate is already as tight as it's ever going to get. Okay, back to the story, because here's the twist I promised you, and it's the part that makes this almost tragic. Remember Elena? The people who actually reach the crossover, the roughly 5% who clear that bar, mostly refuse to believe they've actually won. There's real research on this. Studies of retirees who entered retirement with $500,000 or more found that after nearly 20 years, they'd only spent down about 12% of it. 12%. And roughly a third of retirees actually grew their wealth during retirement. They got richer during the exact phase of life they were supposed to be spending it down. These are people who won the game so decisively that they pulled off the one financial outcome nobody ever actually plans for: dying rich by accident. And notice, this isn't the usual retire at 40 fantasy. This is narrower and stranger. The math says only a sliver of people ever clear the crossover point, and then that same sliver, the ones who finally could exhale, are the ones who can't put the shovel down. There's a name for the trap Elena is stuck in. Some people call it one more year syndrome. You hit your number, and instead of feeling free, you feel like the number needs to be bigger. It creeps from 1 million to 2, from 2 to 3, always just out of reach, and you keep trading your healthiest, most alive years for a pile of money you will statistically never even touch. Bill Perkins wrote an entire book about this, arguing that the goal shouldn't be to die with the most money possible. It should be to die having actually used it, on experiences, on people, on the life the money was supposed to buy in the first place. Elena crossed the finish line at 35 and just kept sprinting, because nobody ever told her the race was already over. Now, earlier I promised you the one scenario where reaching this number and trusting it too soon quietly wrecks you. Here it is, and it's the reason I won't let you walk away thinking saving never matters. The crossover concept has a dangerous assumption baked into it, that the returns actually show up on schedule. 7% is a long-term average, and averages lie to you over any short stretch. Ask anyone who invested from 2000 to 2009. Over that entire decade, the S&P 500 delivered a return of roughly negative 1% per year. 10 years. A dollar went in and crawled back out as 91 cents. Imagine gritting your teeth through the entire 2000s, all the way from the dial-up era to the iPhone, for a negative return. That's not a portfolio. That's a hostage situation. And if you decided in 1999 that the market would carry you from there and quit saving, that decade would have completely flattened you. During stretches like that, your contributions are the only thing keeping the ship moving forward. There's more to it. There's something called sequence of returns risk, which is a fancy way of saying that the order of your returns matters enormously right before and right after you retire. A crash at the wrong moment, right as you start withdrawing money, can gut a portfolio that would have been perfectly fine if that same crash had shown up 10 years earlier instead. Same average return, wildly different outcome, purely because of timing. And then there's us, our own behavior. Firms that track this kind of thing, like Delbar, have found for decades that the average investor badly underperforms the very funds they're invested in, because they panic sell at the bottom and pile back in at the top. The market offers you the full return. Your own nervous system talks you out of half of it. On top of all that, some of the biggest names on Wall Street, Goldman Sachs among them, are currently forecasting returns for the next decade that sit well below that historical 7%. If they're even close to being right, every crossover number I gave you earlier is further away than it looks. So here's how you hold all of this at once, because both things are simultaneously true. Saving more barely matters. And saving more is the only reason it ever stops mattering. Read that again. The crossover is real, but it's a reward, not a starting line. You don't get to skip straight to the part where the market carries you. The only way to build a base large enough for compounding to take over is to save relentlessly, especially early on, during exactly the years when it feels slow and pointless and broken. Your contributions are the one variable you fully control. The market's returns, inflation, the timing of the next crash, none of that is up to you. Your savings rate is. So you pour everything into the one lever you can actually pull, right up until the day the machine is finally big enough to pull the other levers for you. That's really the whole idea. There's a number somewhere around $400,000 for most committed savers where your money starts working for you, and every year after that it outworks you by an even bigger margin. CoastFIRE gives you your own personal version of that number based on your age. Compounding guarantees that the back half of the journey does the heavy lifting. But almost nobody actually reaches it, not because they're weak, but because the income was never there to begin with. And the ones who do reach it too often can't stop guarding a fortune they'll never spend, while the years they could have actually spent it in quietly slip past them. So picture Elena and Marcus one last time. Same age, same city, same funds. Marcus saw exactly where the line was, and the moment he crossed it, he started actually living, and he's still retired with more money than he'll ever need. Elena never saw the line, so she kept grinding for a number that had already stopped mattering, and bought herself an extra $2 million she'll die still holding onto, at the cost of 30 years she never gets back. Both of them made it. Only one of them noticed in time to actually enjoy it. Don't get so busy saving for a life that you miss the exact moment you're finally allowed to start living it. Find your crossover, and when you reach it, have the nerve to actually act like it. Quick reminder before you go, I'm not a financial advisor, and none of this is financial advice. It's math, plus some hard-earned pattern recognition from watching how this actually plays out for real people. What you do with it is entirely up to you. If this changed the way you see your own account, and you want the deeper material on building the income that gets you to the number in the first place, that free community is waiting for you, link in the description. I'll see you in the next one.